intangible asset is an identifiable, non-monetary asset that lacks physical substance. Examples of intangible assets include licenses, patents, copyrights, franchises, goodwill, and trademarks. Externally acquired intangible assets other than goodwill are initially recorded at acquisition cost plus any additional costs, such as legal fees. Internally developed intangible assets other than goodwill are recorded initially at the amount of the additional costs other than those for research and development. Research and development costs must be expensed as incurred, not capitalized except under certain limited scenarios. Intangible assets with finite useful lives. An intangible asset with a finite useful life, an amortized intangible asset to the reporting entity is amortized over that useful life. The amortizable amount equals the amount of cost initially assigned minus the residual value. Amortizable amount equal historical cost minus residual value. The amortization methods are similar to the depreciation methods. The carrying amount of an intangible asset with a finite useful life equals its historical cost minus accumulated amortization and any impairment losses. The impairment test for an intangible asset with a finite useful life, an amortized intangible asset, is a two-step impairment test for long-life assets. Intangible assets with indefinite useful lives. An intangible asset with an indefinite useful life is not amortized. The carrying amount of an intangible asset with an indefinite useful life equals its historical cost minus any impairment losses. Goodwill is an intangible asset with an indefinite useful life. However, the accounting treatment of goodwill described below differs from that for other intangible assets. Goodwill is recognized only in a business combination. It is an intangible asset reflecting the future economic benefits arising from those assets acquired in the combination that are not individually identified and separately recognized. Goodwill has an indefinite useful life. Thus, it must not be amortized subsequent to its initial recognition and is instead periodically tested for impairment. The parent presents any goodwill recognized in its consolidated balance sheet as one amount under non-current assets. Internally generated goodwill must not be recognized in the financial statements. Goodwill recognized equals the excess of 1/2 below. 1. The sum of the acquisition debt fair value of the consideration transferred, any non-controlling interest NCI recognized, and any previously held equity interest in the acquiree. And 2, the acquisition debt fair value of identifiable assets acquired and liabilities assumed, fair value of net assets acquired. If 2 exceeds 1 above, a gain from bargain purchase must be recognized in the parent's consolidated statement of income. As you can see on the table, there are some examples. Entity C acquires 80% of the outstanding common stock of entity D for $192,000. Entity D's acquisition debt fair values of identifiable assets and liabilities were $350,000 and $140,000 respectively. The acquisition debt fair value of NCR was $48,000. The goodwill is calculated as follows. Consideration transferred, $192,000. Non-controlling interest, 48,000. Acquisition debt, fair value of identifiable net assets, acquired assets, $350,000, and liabilities, $140,000. We will take assets minus liability to become the net assets, uh, uh, and to become the goodwill. We will take the consideration transfer. We add the non-controlling interest, and we minus the net assets, the fair value of identifiable net assets. Yes, and it is a acquisition that fair value of identifiable net assets acquired. And then we will get the goodwill here, as you can see, $30,000. Using information provided, assume that the acquisition debt fair value of the identifiable assets acquired was $400,000 instead of $350,000. The gain from the bargain purchase is calculated as below. Acquisition debt fair value of identifiable net assets acquired. We got assets, the $400,000 minus liability of $140,000 to get the consideration transfer, which is $260,000. And then we got the consideration transfer of $192,000 non-controlling interest. Acquisition debt fair value of identifiable net assets acquired will be $400,000 of assets minus $140,000 of liabilities. We will get the result of $260,000, and then we will minus the considerations transferred of $192,000 and minus non-controlling interest of $48,000 to get the gain from the bargain purchase of $20,000. Patience. The amortization period for a patient is the shorter of its useful life or the legal life remaining after acquisition or the moment the application was filed. The useful life may be substantially shorter than the legal life because of changes in consumers' tastes, delays in marketing the product or service, and development of substitutes or improvements. The accounting treatment of the course of the legal defense of a patient depends upon the account of the litigation. The costs of successful litigation are capitalized to the cost of the patient because they will benefit future periods. They are amortized over the shorter of the remaining legal life or the estimated useful life of the patient. The cost of unsuccessful litigation, damages, attorney's fees are expanded as incurred. An unsuccessful suit also may indicate that the unamortized cost of the patient has no value or lower value, and an impairment loss might be recognized. Measurement, valuation, and disclosure. Liabilities. This study unit discusses liabilities. Topics covered in this study unit include accounting for contingencies, warranties, including the assurance warranty approach and the service warranty approach, income taxes, including accounting for assets and liabilities related to deferred income tax, leases, including the differences between operating and financing leases and the financial statement presentation of operating and financing leases. Bonds, the financial statement presentation of bonds payable and the bonds related premium or discount. The effective interest rate method for calculating the interest expense, and the amortization of a bond's premium or discount. Contingencies and warranties. Contingencies US GAAP defines a contingency as an existing condition, situation, or set of circumstances involving uncertainty as a possible gain. A gain contingency or loss, a loss contingency to an enterprise that will ultimately be resolved when one or more future events occurred or failed to occur. A contingency may be probable. Future events are likely to occur. Reasonably possible. The chance of occurrence is more than remote but less than probable. And remote, the chance of occurrence is light. A loss contingency must be accrual. Recognition of a liability and related loss contingency when the following two conditions are met. It is probable that at a balance sheet date, an asset has been impaired or a liability has been incurred. The amount of the loss can be reasonably estimated. The amount with the better estimate within a range of loss must be accrued. If no amount within that range appears to be better estimate than any other, the minimum should be accrued. Disclose of the nature of the accrual and, in some cases, the amount the range of loss may be required to prevent the financial statements from being misleading. If at least one condition is not met, but the probability of loss is at least reasonably possible, the nature of the contingency must be disclosed in the notes to the financial statements, but is not recorded in the accounts. Loss contingencies with a remote probability ordinarily are not disclosed. Gain contingencies are recognized only when realized. A gain contingency must be adequately disclosed in the notes. For example, an award of damages in a lawsuit is not realized if it is being appealed